Thanks for joining us today for the July 2020 Financial Symmetry Market Update. I'm Grace Cavantis, and I have with me Mike Eklund, and we're going to be going over the second quarter of 2022, what's been going on in the markets, and a couple of the hot topics that we're all hearing a lot about these days, and for good reason. First, to start us off, we need to go through our disclaimers that this recording is for informational purposes only. This does not qualify as investment advice and should not be viewed as such. So with that, Mike, can you tell us a little bit about what happened in the markets in the second quarter of 2022?
Yeah, thank you, Grace. Yeah, as many folks who've been watching the headlines or reading the news or maybe looking at their account statements know, it's been a difficult quarter for investors. And as kind of noted on the slide here, you see a lot of red on the page. And that means stock markets down in the US and internationally, as well as bond markets, US and internationally, were all down for the quarter. That doesn't happen very often, but obviously it did happen in the second quarter. The international markets did slightly better than the US markets for the second quarter, but overall it was, there really wasn't a place to hide, as one would say. Although many think cash is, but keep in mind cash with inflation loses money pretty much on a daily basis. So that's kind of what happened in the second quarter on a more of a global scale. We thought it'd be helpful this quarter to kind of show folks on more of a country by country basis, kind of the wide range of results. As this slide shows, for the second quarter, the top performing country was actually China. It was up a little less than 5%, and the bottom performing country was Peru, down almost 30%. Now, where does the US sit? Kind of in the middle, somewhere around there, down between 16 and 17%. But there are other areas including the emerging markets and other areas of Europe and South America that did outperform the US. So I wanted to kind of more show folks the variability of results on a quarterly basis, as this slide can change dramatically.
Yes, and that does change a lot from short time period to short time period.
Yes, I believe China was one of the worst performers in the first quarter, now one of the best performers. So it's not uncommon to see that wide range of results. Next, Grace is going to help us understand what to do now. You see this decline in the stock market. What should we do next?
Yes, so this chart here shows us what historical returns have looked like after market declines. And so you can see that first section is after a 10% market decline. The middle one is after about a 20% market decline, which is around what we've seen so far in 2022. So those numbers might feel more relevant. And then the third section is after a 30% decline. And you can see those 1-year returns, then 3-year returns, and then 5-year returns. And the plus side of this is that all of those are positive, and some of them are, especially 5-year returns, incredibly positive. So this is encouraging for me as an investor, probably for Mike as well, and hopefully for our clients, to know that when we see what we've seen this year, which doesn't feel good when our account numbers are going down, is that what historically has happened afterward looks much better.
No, that's a good point, Grace. And as you, an investor, the people listening can think, you really have 3 options right now. One is you can sell, which obviously we don't recommend. Other is hold, which is, if your situation warrants, is not a bad decision. And then as you see here, sometimes it's a good idea to buy after market declines, which we, recommend and have been doing for certain clients over the last few months as well.
Yes. So Mike, now can we pivot and have you talk with us about another really hot topic in the markets or in just financial media right now, which is inflation?
Yes. And this next slide, that was helpful because wherever you read and talk to people, you hear about inflation nonstop and how it's out of control, how it cannot be, it's going to double-digit levels, and what can we do about it? Obviously the media is one thing, but one thing I like to look at is how the individuals that actually invest money feel what future inflation is going to look like. And so, as you can see by this slide, what it's comparing is the break-even rate between investing in what's called a regular nominal bond that's just going to give you a fixed rate, and then investing into a treasury inflation protected security, which would be more inflation adjusted. So as you saw in March, that expectations was the next 1 year was expecting very high inflation of about 6.3%. But over the next year, the current estimate, and these are people actually investing real dollars, expects inflation to be a much lower level, about 3.4%. I understand that for those who are watching the news, the recent headlines for inflation have been 8 to 9%, but the expectation is going forward over the next year, those numbers will be lower. So I don't have crystal ball, I don't have prediction, but at least those who, investing money feel that we are going to start to see lower inflation in the future.
I think that's encouraging.
It is. I think for many of us, day-to-day living would be nice to have a slightly lower level of inflation because it is definitely a tax on those individuals. So what is impacted by inflation? Obviously, the stock market is down, but many people don't realize when inflation is higher, one of the big detriments is to the bond market. Because keep in mind, if you have a bond that's going to pay you 3% a year, but now there's a new bond out there that's paying 5 or 6% because the investor wants a higher yield because inflation is higher, they're going to want to sell the lower yielding bond and buy the higher yielding bond. And that's what we've seen so far this year, where the US bond market has really had the worst year in the last 45, 46 years on record. Depending on the type of bonds you invest in and the length and the maturity of those bonds, you're down anywhere from 5 to 15%. And that is kind of a shock to most investors because they're typically used to seeing bond market do well when the stock market does poorly, but that's not a guarantee as we've seen this year. But I would say the other line that's highlighted there, the yellow line, has shown last time we've seen a poor start to the year to the bond market, you saw in 1980, the bond market did recover pretty quickly to end the year positive. So no idea what's going to happen to the US bond market this year, but just shows that it's been a challenging year, but this is something that's not normal by any means. Moving forward and to that point on bonds, I'll just kind of spend just a quick second on this slide from Capital Group. Just shows that, for example, for a 2-year treasury, around the March 2020, the COVID low, if you invested in a 2-year treasury, you're getting about 0.10% per year for the next 2 years. And as of the middle of June, that has increased to about 3.2% per year for the next 2 years. So that is one positive for those that are investing new money now or moving into bonds, is that the future returns should be higher because your starting yield is higher. So like the summary, I'd say don't sell your bonds just because they're down. They're actually going to likely provide a little bit more value going forward because of the higher yields. And then finally, this is a slide that we have talked about in different kind of versions in the past. Kind of what do the experts say? Obviously, Grace and I are trying to do the best we can, but I would say we're not experts. But the one thing to keep in mind is as prices fall, value increases, and that's really hard for a lot of people to realize. Is that the value of the companies they're investing in have not really changed. It's just now you're getting them for a better price. Think about if you're shopping and you go to a store and they said everything's 20% off, you probably are more excited to buy those things. And that's kind of what's happening right now in the stock market, and to some extent the bond market, is everything you would have bought at the beginning of the year is now a little bit cheaper. And so you're still buying the same companies, the same investments. It's just now expecting higher returns, as Vanguard has noted on this slide here, that over the next 10 years, and this is the amount they expect per year as of the end of May, so you might see slightly higher numbers here in July after the decline in June, as they're expecting now higher returns for not only US stocks, international stocks, which I expect the highest return. So that's kind of a returning feature or repetitive feature from us here at Financial Symmetry. And then obviously bonds are expecting higher returns than before, as well as US international bonds. So that is the bright light of this recent decline, is that for those that are currently investing new money, they should see higher returns for those investments going forward.
So we go over generally an aspect of Financial Symmetry's general investing principles every quarter. And the one I want to focus on today, and as markets have felt pretty painful, both on the stock side and the bond side this year, is that line that Mike's highlighting, that an investor's returns are incredibly heavily affected by investors' behaviors, especially at market highs and market lows. So bull or bear markets, as it says on the slides. So we want to encourage you to not make hasty decisions. I know just naturally, when things feel uncomfortable, we kind of have this knee-jerk reaction that I must do something. I've got to do something. This feels uncomfortable. Let's act. And so we want to encourage you guys to just be incredibly careful with what those knee-jerk reactions might be. And so sometimes it's just best to do nothing. So whether that's don't look at the account statements, or you feel like you want to go all to cash because that would feel so much safer, it's not a great time for those kinds of moves. So just be mindful of your investor behavior, because it is going to affect your returns long term.
Yeah, and if you're not sure what to do, I think that goes to the next item, the line on the list there, the quality of your investment plan. And I think that kind of leads into the next segue. If you don't feel you have a quality investment plan, it's a great time to reach out to a financial advisor. We recommend a fee-only financial advisor like Financial Symmetry. That's what Grace and I do with our day jobs, is we work with individuals and families to help reach their financial goals. And so if you have any questions about your personal financial situation or investment plan or lack thereof, feel free to reach out to us, and we're happy to help. Mm-hmm. If you have any questions on the presentation and what we discussed here, we're happy to help answer those questions as well. And then finally, we have our contact information. The Financial Symmetry website not only has a blog and podcast where we have regular content on not only investing topics, but also taxes, retirement income, insurance, a number of different topics to help, help you make the smart financial decisions. And then finally, there are Grace and myself's contact information if you have any specific questions for us. With that, thank you for listening this quarter. We'll be back next quarter, and let us know if you have any questions. Thank you.